This is CNBC Reports. As the day comes to an end in the U.S., we give you a first look at the day ahead. Your tomorrow starts right now.
Taking a look at Asia right now, those markets open for business. The Nikkei down 4% right now. As for U.S. futures, after basically tanking today in trade, stocks right now, as far as the futures go, looking quite flat.
Credit fears, recession fears, housing fears. We had all of them today. So all this fear and loathing crushing confidence on Wall Street and Main Street, and for the wrong reasons. Has fear gone too far? John Browne is the senior market strategist at Euro Pacific Capital. Also back with us is Jason Trennert, the chief investment strategist and managing partner at Strategist Research Partners. John, I'm going to start with you. You say no, the fear has not gone too far. Why?
No, it's just beginning because the carpet is being pulled back on a very, very nasty situation. First, a misstructured American economy where we're consuming 50% more than we're producing and bleeding our national wealth at an enormous rate. And secondly, a depression, not caused by economic reasons only, but by fraud. A fraud so bad that the consumer is shaken, but even worse, the financial institutions are shaken because they don't trust each other.
Wow. Well, you know, and yet I got to tell you, fear itself sometimes can be far more. I mean, I know it's been bad out there. And let me just, I talked to two CEOs.
Yeah, but sometimes, but this is not a time.
Let me just show you this, okay? Yesterday,
we're facing reality
the CEO of Office Depot was talking to us. And here's what Steve Odland, the CEO of Office Depot, had to say. I'm afraid too many people are sitting on the sidelines. Too many people are worried. We're talking ourselves into a deeper and deeper recession. We've got to come forward with confidence. Now let's look at the CEO of Accenture, largest consulting company in the world. This guy talks to lots of CEOs. Bill Green. He says we're talking ourselves a deep recession. In challenge and change, there's always great opportunity. We can transform our business models for the future and emerge more relevant, more powerful, and successful than ever. He's selling a little bit of hope. Jason Trennert, come to my rescue, sir.
Well, back him up.
Yeah, no, listen, I think you have to look at objective measures to determine whether there's too much fear. And the objective measures I'm looking at are valuation measures. You look at price to sales, price to book, price to earnings. By any standard, on a 10-year trailing basis, large cap stocks are negative. That hasn't happened since 1828. So, you know, you go, if you believe, with all respect, let me finish, sir. My point of view is if you believe in some sort of return to the mean, it seems to me equities, which have to be looked at as long-duration assets, they're the longest-duration assets you can buy, save for real estate. It seems to me that they seem very attractive and that fear is overdone.
Hey, John, one thing I'm sure of after today's trading, we are closer to the bottom than we've been in a long, long time.
Thank you, Professor of the
Are we going to zero? Are we going to zero, John?
That is true. That is true. We're going towards zero because Jason has made a very interesting statement. But you see, I think it's short-term what he's looking at, and I have respect for him. Basically, if you look at PE ratios and yields on common stock, you're in the areas of the deep-sea bubble in 1720 and the great crash of 29 to 34. This is not a depression. This is not a recession of the 70s and 80s. You've got to have a much longer feeling radar than you are just looking back 10 and 20 years.
I want to get to Jason because what if you look, instead of at PE ratios, what if you look at the credit markets? The implied fair value right now of the S&P 500 is something more like 600, 700. If you look at the credit markets, people are not buying junk bonds right now. Basically, people are looking at junk bond salesmen for all these companies that are supposed to get out of the hole as loan sharks.
Yeah, I think the biggest difference really, though, is that the federal government and the Fed are here. We may get inflation out of this, but this is, in the 1930s, the average PE, believe it or not, was 16 times earnings. The trough in 1932 was 9 times earnings. The only time you've had single-digit multiples was in 74 and 82, periods of very, very high inflation. And you're not going to see that here. Inflation's coming down. I think you could actually have some modest multiple expansion
John, you know what he said,
year.
when Jason talks about the federal government stepping in here, that actually makes me more nervous.
Yeah, well, I'm talking about the Fed in
Well,
particular.
I don't know. I think to get out of this situation, you have to be really bold. I think Obama's going to have to give a tax holiday to every single person and every corporation for 2008 and 2009.
Yeah, that's not going to happen.
he's going to have to think of an infrastructure spending project nearer the 10 trillion mark if he's going to avert a major depression, far worse than 1929.
Okay, hey, Jason.
Because this depression springs from
Jason, I find it very hard to disagree with
leverage than 1929.
With all due respect, from 1929 to 1933, Fed's balance sheet contracted by 30%. They raised taxes. They raised tariffs. The Fed has doubled the size of the balance sheet in 6 weeks.
Enough with the history lesson.
It's very, very
Instead,
different.
I leave it with this. Warren Buffett said, when everyone else is greedy, be fearful. But when everyone else is fearful, it's time to get greedy. Let's think about that. John, Jason, thanks, guys.
You haven't seen fear yet.
Well, okay,
it's
on that
pretty
note.
scary to me, babe.
Coming up next, no more whining about the auto industry.